Everybody. Glad to be with you. Always happy to be at this conference and share a little bit about what's going on in the market. So, for those of you that have heard me talk before and you were expecting a lawyer to talk about some newfangled law or something coming out from the Securities and Exchange Commission, I really wanted to do something different. So, I wanted to talk to you about, given that we see somewhere between 150 to 200 multifamily transactions and other types of transactions close each and every year from LOI to the closing table. I'm going to give you some secrets as to what I see people, clients of ours that succeed in times of crisis. So we're calling this the secrets of multifamily success in complex times. So for those of you that don't think that we're in a crisis, right? The market goes down and then it comes back up. So we're certainly in one of those times when the market's going back down, and we're hoping to see it back up. So I love this quote from Winston Churchill. It says, "Never let a good crisis go to waste." Jack Nicklaus also says, "Crises are a part of life. Everybody has to face them, and it doesn't make any difference what the crisis is." How true is that, right? So for those of us that are in multifamily and in the market, and in this might also resonate with you. Great occasions do not make heroes or cowards. They simply unveil them to our eyes. Silently and imperceptibly, as we wake or sleep, we grow strong and weak. And at last, some crisis shows what we have become. So, for those of you that don't know who I am, I'm a practicing lawyer. I'm the managing shareholder of Kelley Clark. We have offices in California and also in Texas. But for a lot of our clients, they're hunting, buying and selling assets, particularly in the real estate place, all around the country. On average, we'll do somewhere between $4 to $5 billion each and every year. We've done transactions as high as $10 billion, licensed in multiple states, best-selling author of a couple of books. And if I'm going to cram a lot of information into a very tight time period, so if you see something on a slide that you really wanted to see more about, then don't worry. Send me an email or send one of my team members, and we'll give you the slide deck for free. Okay. All right. So let's talk about where we've been in order to see where we're presently at, and then where we're going, and what are the opportunities in this environment, and who are people that are winners and people that are losers, people that are succeeding in times of crisis, and who are people that are struggling. I think it's important for us to have a little perspective on history, right? So when we look at in the late 90s, when I started practicing law, the 2000 bubble, the tech bubble, for those of you that have been around, that was a loss of 1.755 trillion in value, right? We saw literally the stock market crash. We had 77% of the financial markets fell from their peaks. New IPOs frozen, startups imploded. So there were a significant amount of challenges in that particular market. How about the 2008 Great Recession, right? Many of you were investing in that. If you were an investor, a sponsor, syndicator, operator in that time frame, you saw loss of more than $8 trillion in the stock market. Unemployment skyrocketed to over 10%. And the real estate market was really ground zero for this particular great recession. Americans on average lost 9.8 trillion in wealth. That was throughout the entire country. And then we saw banks also fail. And then one of the most recent ones, right? The COVID-19 lockdown. We saw more than $16 trillion in value, obviously lost in this, not counting the loss of life. Various sectors severely contracted: air travel, dining, health, social services, and it changed life for each and every one of us. The way that we interact with one another, the way that we travel with one another, it changed life forever. So what does this tell us, right? What are just these three recessions? Well, these aren't the only three recessions that the country's ever had. We've had at least 34 recessions since 1857, varying in length from 2 months, February to April 2020, to more than 5 years. And that was in 1873 to March 1879. On average, we're going to see recessions somewhere between 17 months while 6 recessions in the 1980s have lasted at less than 10 months on average. So what does that mean for you as an investor? What does that mean for you as a sponsor, operator, a syndicator? Well, that really means is that you're going to have the ability to hang on, really, in these recessions, because they're short periods of time, and you're going to be able to have the opportunity to restructure or modify your existing things. So, what is the current cycle that we're presently in? What has led to this, right? So for us, because we see deals from coast to coast, from operators, syndicators, sponsors that you see on TV or on radio, from people that are just getting started, because of our large volume and sample size, we get to see what has really created some of these pressures. And we can see in general market volatility, right? What's the market volatility? Well, we had historic interest rate hikes, right? From March of 2022 to today. We had over 12 interest rate hikes. We just had a 50 bip reduction in interest rates. But think about that. It never happened in the history of the U.S. economy where we've had interest rates that were so rapidly increased in such a short period of time. We had explosion in insurance costs, 73% in some cases rise in markets. Utilities were up by more than 40%. And then we had what we call maturing rate caps. That's the hedge market on the floating rate loans that many of you that had invested or that had sponsored, operated, syndicated deals on floating rate debt. And then we're facing what we call a giant maturity wall. This giant maturity wall, especially in the bridge space, where you have $728 billion in 2023 maturing and $659 billion in 2024 maturing. What does that mean? Well, this toxic stew of objective market factors were something that created significant stressors in the market. Nobody was stress testing for this. If you're somebody that bought properties and put bridge debt, floating bridge debt on it from like 2019 to 2022, 2023, you were not stress testing these objective market factors. You just weren't. And so, but what that caused is a significant issue in the ability for to be able to succeed. But what I saw was that during these recessions and even in this market volatility, that I saw still huge amounts of massive wealth concentration. So if we look at just a snapshot of wealth concentration, a lot of us know it demonstrates and proves what we already know to be true, right? And that is that in large part, wealth is highly concentrated. It's highly concentrated. It went from 1989, $38 trillion to basically it grew to $115 trillion, 5 times the nation's GDP. And in the distribution of that wealth, we saw the 1% held over 1/3 of the total wealth inside of the country. What does that mean? Well, it means that volatility and complex lending environment creates massive opportunity. We are still now, even now in this latest little dip, right? Hopefully it will go right back up. In this latest little dip, there is the greatest transfer of wealth in human history happening right now. It's in the next in the last 5 to 10 years, for the next 15 to 20 years, there's going to be $84 trillion that are expected to change hands. This is according to Forbes, Wall Street Journal, UBS. Most of the experts in the industry, in real estate, if you're in commercial real estate, believe that this is the greatest transfer of wealth. And so what does that mean? That means opportunity for you. And that means even though you're going to look at this quote and you're going to think this really resonates with you, because you're going to see new generations of investors, new generations of operators, new generations of syndicators are actually flooding into the space. Charlie Munger said it best. He said, we've had the most massive creation of wealth for people a lot younger than those who formerly got wealth in the history of the world. The world is full of young people who really want to get rich. And when I left school, nobody thought it was a reasonable possibility. That means that there are more opportunities, not less opportunities, even now in uncertain economic terms, even now when you're trying to figure out how to get into new markets and you're looking at cap rates that are right now on multifamily properties or other types of asset classes in the 6s, 7s, 8s, 9s, depending on what market you're really hunting in, you're able to see that there are opportunities for you and for your potential investors. So when I started to think about all of the clients that we have, and I started to figure out, okay, the clients that are thriving in times of complexity, what are some of the character traits that we see? What are some of the traits that make them most successful to be able to survive in these times? Not just survive, but thrive, actually increase their net worth, increase their liquidity, increase the opportunities. And so one of these quotes, this quote right down here at the bottom, is one of my most favorite quotes. It says, "The challenge of leadership." So think about this. The challenge of leadership is to be strong, but not rude. Be kind, but not weak. Be bold, but not bully. Be thoughtful, but not lazy. Be humble, but not timid. Be proud, but not arrogant, right? How difficult is that? For most of us, we tend to go on one side or we tend to go on the other. But to be able to have these strong character traits and utilize them with such moderation that you can appeal to a large amount of operators, syndicators, sponsors, investors, people that you're strategic partners, people that you really need and you rely upon for your business to move in this area, that's super important for you to think about. All right, so leadership is not about your title, it's about your behavior. Here's a quote: "And a devotion to your craft during volatile times, rather than play victim and wish things were the way they used to be. Those days are gone. Elevate your leadership game and out-invent everyone around you." So I want to talk to you about a couple leadership traits that I see in some of the most successful clients that I have that have been able to survive in this area. First one, visionary thinking and curiosity. This is a core intangible leadership trait to survive in times of crisis. Visionary thinkers, you might know them, you might have one. If you don't have one on your team, I encourage you to seek out and have a visionary thinker on your team. Teams that have someone that has vision and clarity, leaders that have a clear, positive vision for the change and be able to articulate it confidently. They have visionary thinking. They see change as an opportunity for improvement and believe in their ability to turn that vision into reality. And they are curious. They are innately curious, a deep desire to learn and understand new things. Visionary thinking and curiosity, one of the core intangible leadership traits to survive times of crisis. Helen Keller said, "The only thing worse than being blind is having sight but no vision." The Bible says, "Where there is no vision, the people perish." And then Albert Einstein said, "The important thing is not to stop questioning. Curiosity has its own reason for existing." So be curious, think about, need to have a vision. Humility, the next character trait that one of the ones that I see in clients that are so successful is humility. This is recognizing one's limitations and valuing others' contributions. This is an impact, an environment where team members feel respected, valued, encouraging collaboration and innovation. And then C.S. Lewis said, "Humility is not thinking less of yourself, it's thinking of yourself less," right? Think about that for a little bit. That like might twist your brain a little bit, but that's super important when you're thinking about how to be humble. What's the next character trait that I think that is so super important for you to think about? And this is decisiveness. Decisiveness is making timely and informed decisions. Leaders that are able to be decisive in times of crisis, they are often ones that are those leaders that thrive. Their organizations thrive, their deals thrive, their success thrives. So maintaining momentum and direction. Change often requires making tough decisions and facing challenges head on. So think about the current environment, the current market cycle, being able to be decisive and take advantage of the opportunity. Teddy Roosevelt, one of the most famous presidents, right? The original Rough Rider. He said, "In any moment of decision, the best thing you can do is the right thing. The next best thing is the wrong thing. And get this, folks, get this. This is super, super, super important. The worst thing is to do nothing." So think about, for those of you that struggle with what I call paralysis by analysis, right? You're underwriting deals, but yet you're not getting out there. You're not sending your LOIs out to brokers. You're not actually in the game anymore. You're doing nothing. That is the absolute worst thing. I want to encourage you, even if you're going to try to mix it up or underwrite, continue to underwrite, continue to send out things for deals, because doing nothing in times, even in times of crisis, is really, in my opinion, the worst thing. And then one of these other character traits is diplomacy. So the ability to manage relationships and navigate complex social dynamics tactfully, right? Dynamics tactfully. This ensures smooth conflict resolution and maintains harmony within diverse teams. So think about this. In times of crisis, we have friction. Is the friction that you have with your team positive friction or negative friction? Is it friction that's going to help you grow theoretically into new deals, or is it something that's going to repel you out of opportunities that you might be able to? Diplomacy is certainly something that you need to do. And this is one of my most favorite quotes by Winston Churchill. Diplomacy is the art of telling people to go to hell in such a way that they ask for directions, right? So you're going to have relationships inside of your ecosystem, whether it's with brokers, whether it's with investors, whether it's with partners, general partners, or other strategic third parties out there, in which you need to be able to master this art of diplomacy. These are some other intangible qualities that I think that are as important: empathy, resilience, empowerment, storytelling, integrity, effective communication. These are all intangible character traits that when somebody, I get asked a lot around the country, what are some of the values or the character traits that you think that you see in your clients that are the most successful? Well, here they are. These I've boiled them down, distilled them into like 10 character traits for you to take a look at. All right. So let's talk about, we talked about the intangible traits. Let's talk about what we can actually physically, practically, pragmatically do in order to actually make our deals better, or those of us that are actually have current deals, how can we modify those deals or restructure those deals so that we can actually ride out this period of recessionary period in which we want to see the upswing a win, right? So in June of 2023, the Federal Reserve was not oblivious to what they were going to do. They knew that raising those interest rates, those 12 times starting in March of 2022, was going to cause significant pressure in the commercial real estate market, such that they pushed out joint guidance to the regulators, to banks, to anyone that would listen. The Federal Reserve, the FDIC, the National Credit Union Administration issues joint guidance. And they said, work prudently and constructively with credit-worthy borrowers to restructure or modify existing loans. Because for those of you that were buying and selling or even working in 2008, they don't want another 2008 system. They wanted a system where the banks essentially would pretend loans are performing. Banks will not be punished for those who modify loans. Because a lot of you might think, why would a bank be punished? Well, they have to report to regulators. Regulators look at the loans that banks underwrite to see if they're performing loans or non-performing loans. And banks are borrowing money from the Treasury and from the Fed in order to basically be able to loan that money out to you to be able to buy assets. So it's super important for you to know that that banks were instructed in June and July of 2023 that they needed to do something different than what happened in 2008, where there were massive foreclosures. So they want banks to actually modify and do that. So here are the potential areas of modification. For those of you that have existing deals, these are the categories in which you really want to pay attention. Fixed rate, your rate cap, your reserves, your debt service coverage ratio, which is your DSCR, your maturity date, and fees, right? So what does that mean? What are the steps that somebody might actually have to go through in order to modify an existing loan that they might be in? So here are the steps. Step one, I'm going to give you the key steps, all right? These are the key steps. You're going to enter into what's called a pre-negotiation agreement with the lender. That might be in writing. It might be an email. It might just be orally. But these are where you're going to be able to agree with the lender that you're going to enter into confidential communications with them about how to restructure your loan. There's going to be a plan. You're going to have to lay out a hardline timeline and a specific plan for restructuring. If you don't know what the plan is for your particular loan, but you know the symptom, you know that you don't have enough money or revenue in order to service your current debt, or your ability to forecast out when you're going to run out of cash, then get with somebody. You can call our firm. We'll help you underwrite your deal to figure out exactly what the symptom of your inability to pay your bills, what is at the root cause of that. So that's super important for you to be able to understand that, to cohesively and coherently present a timeline as well as a specific plan for restructuring. The lender is going to perform due diligence. So those of you that have gone through acquisitions before, and you know that they've done the thirds, right? Your phase one environmental, your property condition report, your appraisal. They might do this again just to see where your property or your loan sizes up in connection with where the current loan is. And so don't be afraid of that. The lender is going to dig into your plan. The lender is going to dig into your property and actually see. There's going to be negotiation, right, on all of those categories that we talked about: the type, the rate, the pay down, the DSCR, the maturity. Those are potential areas of levers in which you're going to be negotiating theoretically with your lender in order to step up those negotiations. And then 5, you need to understand this is going to be papered up. This is going to be something that is going to supersede. It's going to be something that is going to control in areas of conflict with your original loan documents. So those of you that think that this just happens and then the lender just magically says, okay, let's just do it. No, it's actually, there are going to be amendments to your loan agreement. There might be amendments to your promissory note. There certainly will be something in writing that modifies, and it should match essentially what the terms are that you reached. So here's a key point, right? In times of volatility, especially market volatility, you need to keep your investors informed. Do not keep them in the dark. Do not paint an overly rosy picture that they don't know what's going on, right? Because everyone ultimately wants to eat, but few are willing to hunt. Now, what do I mean by that? That means that we're in a market and we're in a generation when people think that things are easy, when they think that deals, right? Because from 2010 to 2022, basically you could throw a dart at a dartboard and make money in the commercial real estate market. Almost anything that people were buying was appreciating or it was cash flowing. And then and we were seeing massive cap compression, right? So from 2010, right? So remember the Great Recession in 2008, people were getting rebanked in 2010. So 2 years later, they were getting rebanked and they were reloading on new deals and they were making massive amounts of money because we were seeing values increase, cap rates compress, and we were seeing being able to take advantage of the market. In this market, you're going to find a lot of people, potential partners, third parties, strategic investors who want to eat. They want the returns, but few are willing to hunt. And the question is, are you going to be somebody that's willing to hunt? Are you going to be somebody that lets fear theoretically often prevent you from acting or taking control of your destiny, right? So remember those intangible character traits that I talked about, those 10 character traits. Those are the people that grappled with fear, but also wrestled with it and went forward and actually moved through that. So don't let procrastination or fear control you. That is the biggest impediment that I see to success in the last 24 to 25 years is people that are so paralyzed. They're paralysis by analysis, or they procrastinate and they're not able to actually get off the sidelines and get into the game in order to actually do something. So that's super important for you. Here's our contact information. If you'd like to reach out and get a free consultation on an existing deal that you have, remember that root cause, right? We're experts at trying to find the root cause of what's going wrong theoretically in your deal, and then theoretically, what can you do with your existing deal so that you can ride out that short period of time that hopefully you can take advantage of the upswing in connection with this. If you want to know more about the firm or me, you can always follow us on social media. Kelley Clark, we're on Facebook, we're on YouTube, we're on Twitter as well, or X as it's now known. So hopefully this was helpful for you. Let's see if we've got a couple questions here. We don't. That's great. That means everything that I said was perfectly reasonable, rational, and it was articulated very well, Raman.
That's great presentation. There is one question, Dugan.
Okay, so Amir says, thanks, Amir. How long do loan mods take? How do you get reserves until you complete the mod? That is a great question. So for those of you that have a floating rate loan, you're likely your bridge lender already has CapEx that's built into your loan. And you may be in cash management. You may not even have access to your reserves by virtue of your DSCR being blown. Maybe your lender has stopped funding your CapEx and what your reserves are. So during that modification, during that negotiation process, a lot of times we'll ask the lender to release the CapEx reserves, particularly if it's integral to increasing NOI at your property, if it's integral to your business plan. And there's usually a negotiation that happens, Amir, about how that stuff is. Now, how long loan modifications take? I've had loan modifications take hours, and I've had loan modifications take months. So it really depends on your lender, what's important to your lender. We spend a lot of time flying back and forth between New York City and other places, because New York City is where most bridge lenders in the space, for those of you that have bridge loans, that's where your lender typically has their corporate headquarters. I'm a big believer in doing business face to face. And so it's super important for you to have clear lines of communication with your lenders. Ironically, your leverage to get loan modifications is the distress at your property. So you do yourself a service by pretending that you don't have problems at your property. You actually do yourself a service if you're transparent with your lenders a lot of times and telling them exactly what it is. But having a cohesive plan will help accelerate your timeline. It will help you get access to potentially frozen reserves, whether those are CapEx or interest reserves or other reserves that the lender presently has in your loan. And it will help you get a memorialization of that loan modification so that you can move forward. Yes, Arbor, MF1, ReadyCap are all in New York. Yep. Absolutely. All of those are big bridge lenders. Lument is out there. Oryx, which is one of their subsidiaries. Bellwether. Almost every lender has their corporate headquarters in New York, because New York is still the financial universe of the world, right? Most of us that live in Texas like to think that Texas is. It's not yet. It's not yet. So New York is still king and queen when it comes to the financial lending services. But be aware, each of those bridge lenders, they all have their own little special nuances. Some of them won't talk to you about loan modifications unless your loan is actually in monetary default. Some of them will only talk to you if your loan is brought current. So it's just very important for you to understand what the flavor and the special considerations are that your bridge lender are really going to want to see.
Awesome. Yeah. Cool.
All right, brother.
Yeah. I didn't see any other question. Yeah.
Have a wonderful time.
Yeah. Awesome. Thank you very much, Dugan. Again, that's a wonderful presentation.